It's safe to say that the U.S. is going towards a phase of hyperinflation, which would possibly result in a recession in the country. Supply chain disruptions, excessive job cuts by big companies in the market, currency devaluation, and other indicators all point toward the economy weakening and business leaders growing fearful. So sit back as we discuss the ongoing events in the U.S., which indicate they're in a big pull of recession. First off, analyzing the landscape of the recession. Families in the working class are concerned about feeding their kids. The promised American ideal of home ownership and establishing a family is something that many young individuals grieve, not being able to afford. The United States was enjoying financial prosperity just a year ago. Currently, stock market assets, 401ks, and college savings for the kids have all significantly declined, with no end in sight. As hundreds of recently laid-off tech workers post about their downsizing and search for new employment on LinkedIn, the results are very clear. The game in the field has shifted, noted renowned investor Bill Gurley in a helpful Twitter thread summarizing the current environment. Tech companies have developed a Disney-like set of experiences and expectations during the economic boom. You can't wish away the truth that you are living on borrowed time if your company isn't cash flow positive and capital is suddenly expensive, continued Gurley. Secondly, Zuckerberg might be panicking. According to reports, terrified employees of Facebook's parent company, Meta, are preparing for job reductions of up to 10%. The imperial boss of the formerly invincible social media giant Mark Zuckerberg promised to crack down on underachievers. When Meta Human Resources Chief Lori Gohler implied in a memo that workers who couldn't perform to standards in this new, more demanding environment might have to be concerned about the security of their positions within the company, she hit a nerve of terror. And as TikTok keeps claiming more market share, Meta has been feeling some pressure lately. Up next, Wall Street experts sound the alarm. Michael Burry's name may ring a bell because of the book and movie The Big Short. He was one of the few investment advisors to predict a free economic and stock market crash. When the stock market plummeted during the Great Recession, his reputation for making accurate market predictions was solidified. Burry has been sounding the alarm that the U.S. economy is about to take another dive, which would have an impact on the labor market. He's also charged President Joe Biden with changing the parameters for what defines a recession after sensing that the White House is refusing to acknowledge the severity of the situation. Burry pointed to the fact that Americans are using credit cards to pay for their high living expenses. The rising debt interest rates will make customers even more anxious. His opinions are supported by a recent Maru Public Opinion survey, which indicated that 57% of Americans are concerned about how inflation will affect their financial condition, and the 14% are afraid that their standard of living will fall. The head of Rubini Macro Associates and a professor at New York University's Stern School of Business, Nouriel Roubini, claimed that there are numerous reasons why there will be a major recession and financial crisis. Roubini is another expert who predicted the financial meltdown of 2008 and 2009. We don't think it's going to be wise to ignore Burry's claims in these trying times. Followed by Walmart's warning. Walmart's management lowered its profit projection for the current quarter and the entire year, which caused a roughly 10% decline in share price. The biggest big box retailer, Walmart, serves as an economic thermometer. It's concerning that one of the most prosperous American businesses that serve working Americans is having financial problems. Families are limiting their purchases as prices gradually rise and inflation reaches a 40-year high. They are saving money on electronics and other things that don't need to be purchased right now, while they are purchasing necessities such as food, which obviously have poor profit margins. And since the big-ticket items generate greater revenues, Walmart and other businesses share a dilemma. Concerns exist in a number of other industries as well. For instance, Wall Street has fewer M&A IPOs and deal-making activities. Additionally, struggling families are abandoning their plans to buy homes because they cannot afford the higher monthly mortgage payments. Similar to this, renters in big cities are struggling to make ends meet. Lastly, a silver lining. Ed Yardeni, a well-known Wall Street analyst, provided us with some comfort. Finally, some good news. In an interview with Bloomberg, the veteran financial expert claimed that this bear market's worst days are behind it. The president of Yardeni Research claims that the S&P 500's plunge to a low of 3,666.77 last month was probably the bottom of the stock market crash in 2022. Additionally, he knows that recent business earnings largely appear healthy as American consumers continue to spend, and the unemployment rate is still high. And here's some other related news you might have missed out on. Firstly, Dow jumps 300 points. The stock market soared on Thursday despite the U.S. economy plummeting for the second consecutive quarter, a significant recession indicator that alarmed markets. But the majority of economists contend that the economy is still far from entering a real recession because of strong job growth and consumer spending. Despite the bleak economic picture, stocks moved marginally higher. The Dow Jones Industrial Average climbed 1% or over 300 points. The S&P 500 gained 1.2%, and the tech-heavy Nasdaq Composite gained 1.1%. 3%, following a first-quarter GDP decrease of 1.6%. New statistics from the Bureau of Economic Analysis showed that the U.S. economy shrank at an annual rate of 0.9% in the second quarter, far below the 0.3% increase. Many experts continue to argue that the economy is not yet in a full recession, pointing to the strong labor market and healthy consumer spending, even though the most recent data undoubtedly adds to ongoing concerns about an economic downturn in the markets, especially as the Federal Reserve continues to hike interest rates aggressively. On Thursday, investors continue to evaluate the most recent round of second-quarter earnings, with shares of Facebook parent company Meta plunging nearly 6% as management warned of poor advertising demand in the context of the difficult economic climate. Comcast stock dropped over 10% after the business failed to acquire subscribers for the first time ever, and Stanley Black & Decker, a manufacturer, witnessed a 15% decline in its price when management lowered its earnings forecast, followed by Amazon stock jumps after hours on quarterly sales increase. Despite showing a quarterly loss after the bell on Thursday, Amazon.com shares increased by 12% in after-hours trading as the company revealed that second-quarter sales at $121.2 billion exceeded Wall Street's projections. The business stated that it anticipated third-quarter revenues to be in the range of $125 billion and $130 billion, with the high end exceeding FactSet's consensus view estimate of $126 billion. Despite pressure from inflationary price hikes, the corporation is making progress on cost, according to Chief Executive Andy Jassy in a statement. Compared to the third quarter of last year, when operating income totaled $4.9 billion, Amazon said it now expects third-quarter operating income to be between $0 and $3.5 billion. The tech and retail giant announced sales of $121.2 billion, up 7% over the previous year. According to FactSet, it was anticipated to announce a quarterly revenue of $119 billion, but it recorded a loss of 20 cents per share when FactSet predicted a net income of 12 cents per share. And lastly, demand increasing for iPhones despite slumping economy. According to Apple Incorporated, which helped to surpass Wall Street projections and anticipated higher sales growth on Thursday, part shortages are decreasing and demand for iPhones is continuing despite consumers cutting down on other purchases. After the findings were released, the shares of the Silicon Valley giant increased by 3.5%. Despite the fact that global macroeconomic indicators are deteriorating, Apple's chief financial officer Luca Maestri told Reuters that demand for iPhones, the company's main source of income, has not slowed down. When Wall Street had anticipated a 3% fall, phone sales in the third quarter of the fiscal year increased 3% to $40.7 billion. In contrast, according to data from Canalys, the whole worldwide smartphone market fell by 9% during the most recent quarter. In the past, Apple's devoted and generally wealthy customer base allowed it to withstand consumer spending declines better than other brands. The company's most recent quarterly results point to the recurrence of a similar pattern. According to Canalys research analyst Runar Bjorhop, Apple, in that sense, has a certain resilience that will allow it to be harmed less than many of its competitors. The slumping economy is damaging sales of marketing accessories and home products, Apple's Luca Maestri claimed in an interview, calling the units pockets of weakness. He further reassuringly said that they would be able to navigate these pockets of weaknesses with the help of the company's broad portfolio of products. That's all for this video. What predictions do you have for the U.S. economy in the near future? Do you think we're heading toward a global recession? Let us know in the comments below. And remember, don't forget to like this video and subscribe to our channel for more exciting content in the future. Thanks for watching. See you next time.